Hey, folks, Facebook is getting crushed. Can you see this? Look, Facebook is down 19.1%. I don't know if you can see that or not. And I chuckle at this because not that I'm glad that Zuckerberg is losing money. I like Facebook. I think Facebook has done a great thing to connect me with some of my friends and whatnot that I never would have been connected for before. But I just find it ironic that it's getting crushed because did any active manager call that? Did any active manager yesterday at this same time say Facebook's getting crushed, we better get out? No one did. That's the whole point about active management. They say they can call the markets and protect you against your bottom line. Well, guess what happened? Facebook is, well, here, let me introduce the YouTube channel. So welcome to the Heritage Wealth Planning YouTube channel, my friends. We are live in my back patio. It's about 95 degrees here in Georgia, but we got a nice cool breeze coming through, so it's fantastic. Don't forget to subscribe down below right there if you like what you see here at Heritage Wealth Planning, and then hit the notification button to be notified of future content. We're going to try to do one of these live chats every day because I got tons and tons and tons of stuff that I want to share with you that I think you'll find informative for sure. All right, so if Facebook is hammered down 20% or so, I don't care. Don't follow it. Doesn't bother me in the least. Whatever. You got to expect this stuff. But the issue that we have here is all these active managers will say, oh, we can call the market. We protected the market in 2007. We protected the market in 2000. There's just no legitimacy to this whatsoever. You're going to hear that. On top of that, they're going to charge you 1.5 a point, something like that. It's just silly talk. And here's what happened with Facebook. And this is where I cut my teeth at Schwab in 2000. I will never forget this. After market hours, when the market starts tanking because of Facebook earnings comes out after market. That means when the market has closed in America for the day. So what happens? Everyone and their mom starts scrambling that night to try to get their orders in. And what happens at the beginning of an open order that you put in Facebook at the previous night? And that simply means when you've got an open order, you put an order in, you want to sell your Facebook shares on a Wednesday night. Nothing gets executed until the opening of the market. It was at 9:30, I think, is when the market is open. What happens in the interim, the aftermarket hours? The market tumbles. And so then your order, if it's a market order, gets executed the very first opportunity, which you just got hammered. So you did an open order in the night before, and it took all that money down and got hammered because you didn't put a stop loss order. You didn't do anything to protect your bottom line. That's what happens when you're doing an open order. That's not why I want to talk about this here today. But what happened with Facebook? Who on Facebook or what kind of analyst, what kind of money manager, what kind of hedge fund said, we think Facebook's going to fall off a cliff. We're going to get out yesterday at this time. And the answer is nobody did. Nobody knew. This is the issue with active management. They say they can predict this stuff, and there's simply no evidence of that. So I want to share with you something. This is from 2000, first quarter 2000. I've kept it for going on 20 years now. Because stuff like this just bothers me. And this is from First Citizens Bank, but it's not, they don't write it. They actually took it from DLJ, which is Donaldson, Lufkin, Genret Securities Corporation. DLJ was pretty big back in the day. I don't even know if they're still around, frankly. So first quarter 2000. Do you remember what was happening in the first quarter of 2000? Everybody and their mom was thinking Dow 30,000. Remember, James Glassman wrote the Dow 30,000. He was right, by the way, but it didn't happen right at the same time he wrote that. So everyone thinks James Glassman's an idiot. He was right. It just didn't happen the way it did. But anyway, we had the Dow 30,000. We had all these people going to tech stocks. I remember I was working at Vanguard at one point back in the late 90s, and we had this money manager, Bill Neff, for the Windsor Fund, and he was only clocking 10% annual rates of returns, and everybody hated that guy. Said that guy should be fired because I'm getting the U.S. Growth Fund at Vanguard was getting 30% a year from 95 to 99, and Windsor was only getting like 10%. Everyone hated Bill Neff. Neff is his last name. I can't remember if it's Bill or John. But anyway, so everyone's saying, I don't want that guy. Anyway, so let me read this to you. The stock market. A rally among technology stocks energized the NASDAQ Composite Index recently as a closely followed tech gauge passed the 5,000 mark. A return to the psychologically important 10,000 point level for the Dow, however, has cast widespread doubts about blue chip stocks, which have long been a mainstay of the U.S. economy. The Dow's decline, because remember, at the end of 1999, going into the first quarter, the NASDAQ was still going through the roof. It was in March of 2000 when the NASDAQ hit that $5,000 point threshold and since tumbled. But they don't know that when they wrote this. The Dow has started to trail. All right, at the beginning of 2000, the Dow started going down. The Dow's decline, I'm sweating again, so just bear with me. The Dow's decline reflected the selling of traditional industrial old company stocks in order to jump into the currently perceived faster growing tech-related stocks of the new economy. Now, you might be too young for this. You might remember that. I remember this like it was yesterday. I'm telling you, the Bill Neffs of the world and their Windsor Fund, they wanted their head on a platter, and they wanted the U.S. Growth Fund. The Vanguard had the Capital Opportunity Fund. And it's not just Vanguard, it's all these guys. They wanted the high-flying tech stocks. They wanted the Internet Fund. Investors have decided to pour money into revitalized sectors such as semiconductors and biotechnology, plus a number of emerging areas such as business-to-business, internet, and fiber optics. Overall, now this is DLJ. This isn't some fly-by-night, folks. These are guys who did this newsletter that First Citizens Bank and many others subscribe to and pay premium money for, by the way, DLJ. Overall, we remain bullish towards equities, but caution that the months ahead could well be volatile as Fed monetary policy unfolds. The central bank's FOMC, Federal Open Market Committee, noted at the conclusion of its February 2nd meeting the potential for heightened inflationary pressures still exist. These comments, plus any recent economic data, have heightened expectations for additional rate hike in the FOMC meeting on March 21st of 2000. Now, listen to this. Going forward, we have revised our 2000 EPS earnings per shares estimate on the Dow Jones at 530, down from the previous estimate of 565. Our price target for the index, so listen to this. The index is now at 10. It had fallen a little bit. Our price target for the index remains at 12,995. Assuming a peak multiple of 23, that's just $23 for every dollar of earnings, our price target for the Dow is 13,455. So they're saying they expected the Dow to be at 13,455 going into 2001. That's from DLJ. You know what happened? The Dow, or the S&P, even worse for the Dow, the S&P fell 9, 11, and 22% consecutively going into March of 2003. We had a little bit of a dead cat bounce in the beginning of 2003, and then it fell again. And then, I wouldn't say it took off after that. Here's something else. This is from Business Week. And again, this is from 2000. I'm not sure what month this was. Oldies but goodies. And you can see that right there. Enron going up. This is from Business Week. In the past year, Enron stock price has more than doubled to 73.06, with shares trading at a lofty 44 times estimated 2001 earnings. Enron has had a great run, says Oscar Castro, manager of the Montgomery Global Communications Fund. The very first fund I ever owned was the Montgomery Emerging Markets Fund in 1994. It's just funny because I bought that based on past performance. So that was it. I had no clue what I was doing, but I put, I think, $2,000 in there based on past performance. But Oscar says, but Enron is still a good long-term investment. Another fan, Chris Wolf, the equity strategy at JP Morgan, private client company, expects Enron share price to hit 100 during the next 6 months as the company sees rising trading profits from the volatile energy markets and rapid expansion online. Now, look, it's easy to pick on people hindsight. The issue is that's active managers. Did any active manager predict Enron? Maybe a couple. Were you able to find out who they were in advance? No. Did any active managers predict the Facebook debacle that's happening right now? No. Is it 20% a horrific debacle? No. 20% happens all the time. Here's another chart. This just right here. See the red every single year. This is going to be hard to see. Maybe one of these days I'll scan this and do a thing. That is from the top to bottom on any given year. And you see every year the markets get hammered every single year. So in 2000 and was that 2003, the market returned 26%, and that's the S&P 500. But even in that year, is down 14% at one point. In 2009, the market was up 23%, but even in that year, is down 28% at one point. In 2010, the market was up 13%, and even in that year, is down 16% in one point. And this is the issue. No one can predict this stuff. We don't know. That's why you can't have an active manager, because you're paying for some guy to outperform the market based on his ability to predict it and time it. It just can't do that. Now, anyone worth his salt who's a trader would have had a stop loss on a sale going to the market tonight this morning on Facebook. I learned that the hard way. It was I think it was Yahoo. I can't remember. I had an open order on Yahoo in 1999. It wasn't Yahoo. I forgot what it was. I had CGMI. I forgot. I had a stock and I had an open order going into the trading session the night before I placed it. I had no clue what I was doing. Yeah, I was on the trading desk for Schwab, so I did know what I was doing, but I just put an open order because the market was going up, up, up. Overnight earnings in Japan or something like that were just, I can't remember, but overnight earnings in overseas markets were killing stocks. And I woke up the next day and I was down 40% just from the pre-trading from the night before. You can't have open orders. The open orders are bad. And if you're going to have an active manager, he's not going to have, or she won't have an open order. That'd be stupid. But at the end of the day, what are they going to do? It's too late to respond at 4 o'clock in the afternoon after Facebook releases its earnings. You can't do anything about it. So you just got to go on for the ride, which is the whole point. If these guys are so, they should have been able to see this Facebook thing, and they're not. And so don't pay the 1%, 2% fee for underperformance. Doesn't make sense. Here's an article from the Wall Street Journal. And this is from December 2010. And I cut this out because the return of the market-beating fund manager. And it's funny, I just got off a podcast listening to, and I'll show it with you because this is a good podcast you should listen to. It's Med Faber, and you should listen to that guy. It's a wonderful podcast. The dude is he's just stellar. I love the guy. Anyway, the guy who was on the podcast is a hedge fund manager analyst, and he's saying, now this is in July of 2018, that all the money is going out from the active managers, and it makes them sad. And I get that. But this is from 2010, and they're saying the return of the market-beating fund manager, and even then, it hasn't happened. It's the days are over, my friends. Don't pay significant amount of money for active management. You're not going to outperform. You're just not. And the issue is, can you find some guy who's proven to do it over the past? Yeah, but could you have found him in advance or her? No, you can't. So you got to be diversified. Just keep it simple, stupid. Watch your fees. Everybody who's worth his weight in gold will tell you the number one way to predict performance among managers, among mutual funds, among ETFs, the number one thing, don't tell anybody, the number one way to predict performance relative to your peers in the industry, is fees. Everybody knows that. I got an article on my blog, and I'll post it on the link maybe here, about the Morningstar, all these PhD professors, all these finance guys. The number one thing you can do to predict performance relative to your peers in the market is watch your fees. There's no getting around that. And I hope I was able to give you some light on some of this, because I think if nothing else, if I can save you a couple bucks in investment fees, it's going to be worth it for you subscribing here to YouTube. Oh, lastly. July 24th, 2007 from CNN Money. Why banks beat bonds. I bought this hook, line, and sinker. I'll never forget that. So basically what they're saying is you could buy a bank stock and get a pretty significant dividend yield. The dividend yields are taxed much more favorably because of the qualified dividend interest, QDI, qualified dividend tax rate, which Bush signed in 2003, I think. Anyway, so qualified dividends from banks and other manufacturing companies, whatnot, are taxed much more favorably than interest from bonds or CDs. And so the argument here was banks beat bonds. And if you bought a bank, you're getting a 5% dividend yield, is only taxed at 15%. But if you bought a CD, you're getting a 5% CD rate, is taxed at ordinary income. And ordinary income is the worst kind of taxes you can have. And then, do you know what happened the following year? Banks got hammered. They stopped paying dividends. There was no liquidity in the market because of mark-to-market accounting. They got destroyed. So anyone, old Josh included, I had a bunch of bank preferred stocks in my portfolio, and that was bad because a preferred stock, it only pay the dividend if it pays the other dividends first. So what happens is, if you have a bank based on the dividend, it won't pay the dividend if it doesn't pay the preferred stock dividend, if that makes sense. So you have a couple different issues. Or a bank has a bond issues outstanding. A bond you have to pay the bond. Then it has a preferred stock, which is a quasi-bond, quasi-stock. As a preferred stock, it gives you a dividend rate, and then you have just regular ordinary dividends. The bank won't pay the ordinary dividends if it cannot pay the preferred dividends, and it will still pay the stock first. So when it comes to order of what's the word I'm looking for? Of obligation, there's going to be the bond, the obligation to pay the bond. The second will be the preferred stock, and the third is going to be the actual equity stock, the dividends that you get. And so what happened was when they stopped paying dividends outright, they stopped paying on the preferreds as well. Never mind the bank dividends. There's no bank dividends to be had because they stopped paying dividends. They're lucky to pay the bonds, and a lot of these banks refinance that debt and whatnot. So the bondholders kind of took on the chin. But in particular, the preferred stocks, a lot of people are getting these 6 and 7% preferreds. They weren't getting those anymore, and there's no equity backing. So at least in the bank, if you have the equity, if you have the stock, you can get some growth there potentially. But that was a tough time. And again, am I here to bang on Sean Tully? I don't know who this guy is. Well, he's the editor at large of Fortune, so he's not some schmuck. No, I mean, have I made mistakes? Absolutely. What I am here to say, if these are the smartest guys in town, if they can't figure this out, your average run-of-the-mill mutual fund or ETF manager charging 1.5, you're not going to win. Just go to Vanguard. USA has index funds. USA ones are a little bit more expensive than I'd like. Betterment, you go there. My man, Jazz Wealth, Dustin over there at Jazz Wealth. I like him quite a bit, actually, in Florida. He's got a good YouTube channel, as a matter of fact. He runs money for 50 basis points for a nice diversified portfolio. It's pretty good. You just got to watch those fees. All right, folks. So I hope this is fine and informative. Like I said, don't forget to subscribe down below and hit the notification bell to be notified for future content. I'm just going through my stuff. I got tons and tons and tons of articles that I've kept like this over my 20 years. And because I always thought I was going to have a chance to talk about this stuff when I worked for USA, but you don't, and I don't blame USA, but they make you only say what the corporate line is. And I get that, but I don't work for the corporate line anymore, so I can say whatever I want, which is pretty sweet. And I'm gonna. So subscribe if you like what you see here. Thumbs up, comments are always welcome for sure. Share the videos with people. I tell you, on one of my videos on Social Security for spouses, for survivors, I can't tell you how many people are commenting on how they were misled. They weren't advised appropriately down at the Social Security Administration. I'm like, man, please share this video because there are other people out there, not this one specifically, but on Social Security, that are relying on the Social Security people to steer them right. And the Social Security people I'm not saying they do it not nefarious, but they're just trying to get you out of there as quick as possible with as much money as you can get today. Oh, thanks, Ryan. Appreciate it, man. Keep up the good work. I'll send you $10 for that. But just make sure you tell these people, if you like what you see here and other people's YouTube things too, you gotta share those so other people don't get hoodwinked when they go to Social Security office or buy some insane expensive mutual fund or something like that. So anyway, we'll see you next time. Appreciate your comments, my friend, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks now. Am I sweating like a pig or what?